identical down to the colour of the doorknobs and the direction in which the cupboard doors open in the canteen. People can move seamlessly from one to the other. Intel will obviously operate wherever they can make most profit. They can make most profit where costs are low. Costs generally meaning wages are low, taxes are low, and the operating costs by way of infrastructure are low. So when countries are looking to attract Intel to invest, they will see what they can do about wages, infrastructure and taxes. And the easiest one for them to manipulate is taxes. So countries will try to reduce their tax rate as low as possible in order to attract these companies in. Why do they want to attract the companies in? Well, it's obvious. These companies will come in and create a great deal of employment. Even if they don't pay very much tax themselves, the logic goes, if they employ thousands of people, then those people are not unemployed, they're not in receipt of social welfare. Those people themselves are paying tax on a personal basis. They're spending money in the local shops. So it generally creates an impetus for the economy. So everybody wants the multinational companies to invest in their country. These slides, I don't know if you can see. If you look at the first one, the main line is, sorry, I'll stay near the microphone. You can see that over time, from 1985 up to 2005, so you've got a 20-year period here, and you can see the average tax rate, corporate tax rates for companies. The purple line is the EU 15, the main 15 countries of the EU. And you can see that over time, the average tax rate is falling. For the newer entrants into the EU, it's falling even lower. And for the countries that want to join the EU, they're reducing their tax rates even further. Now, what does that tell us? That tells us that there is what's called a race to the bottom. So I lower my tax rate a little bit, and then somebody wants to attract Dell out of Ireland into another country. They lower their tax rate another little bit. And eventually, if you want to get the large multinationals to locate in your country, you need to reduce your tax rate. And it's reduced and reduced and reduced until countries that are new to the game, Ireland have been involved in the game for a very long time and very successfully, but countries that are new to the game need to start off by offering a very, very low tax rate indeed. So there is this kind of race to the bottom, and tax competition is the term which is generally used. Now, there is a kind of a wide acceptance among economists that competition is a healthy thing. People think competition is good, it means cheap flights, it means cheap bread, it means cheap coffee. And to an extent it does if you are a person who has a choice as to where you buy your bread and where you buy your coffee and how you take your flights. But if you think about tax competition, the countries are competing for the attention of the multinationals. Who has the choice? It's not the people who live in the countries. They can't necessarily up sticks and move to a different country for a different tax regimes. It's Dell and Intel and Microsoft. They're the ones who benefit from the competition. They're the consumers of the low tax rate, if you like. So tax competition suits multinational companies very, very well. They're extremely keen on it and very uncritical. Increasingly, though, tax competition has become, the term that is used is harmful tax competition. And bodies such as the EU and the OECD have brought out statements on harmful tax competition, trying to define where the line should be on this race to the bottom. How acceptable, when do you cross the line and become unacceptable in your competing? So, as you'll see, Ireland have sailed rather close to the line in the past, so we'll come back to this one when we talk about Ireland. But this is the first form of tax competition and the part that people are most familiar with, which is the idea of lowering your tax rate. So you can see how that one works. The other thing that countries use to attract in companies are a network of tax treaties. Now, tax treaties in themselves are a very sensible thing. A tax treaty arises where, for example, two countries have the right to tax the same income or have some kind of claim on taxing the same income. So, for example, if I were to go, I live in Ireland and I'm resident here and I pay tax here. And if I were to go to France, if somebody wants to invite me to France to give a lecture and pay me a vast amount of money, that would be nice. And if I earn €10,000 or something in France, then the Irish government would say, well, we have the right to tax that because you are Irish resident. But the French government might say, well, you earned that money in France, so we have the right to tax that. And so I could be faced with a situation where I would have to pay tax in France and pay tax in Ireland, which would be nonsense. But instead, Ireland and France have a treaty. It's called a double tax treaty, so it's to avoid the double taxation. And they decide generally who has the right to tax any kind of income. The home country, which in my case would be Ireland, or the host country, which in this example would be France. They also decide which countries have a right to impose withholding taxes. So if I earn interest income in France, that will be taxable in Ireland because I'm resident here. But the French government may have the right to withhold a little bit of the income as tax, and then I can apply for a refund. So the tax treaties are arranged one-to-one, country to country, and there are more than 5 years ago, there were more than 2,000 such treaties in existence. There are many more by now, I imagine. So they're arranged country by country, and they make a certain amount of sense. And it's good for a country to have them, particularly a developing country, because they give stability and predictability, and they make it easy for you to go and do business in the country because you know you're not going to get into a mess tax-wise. For multinationals, though, they're very good at managing tax treaties and using tax treaties. And there is a thing which tends to be referred to as treaty shopping, whereby a company might set up in, for example, the Netherlands, where you've got a great deal of tax treaties. They might have a headquarters in the Netherlands, and they might have a manufacturing plant in, for example, South Africa, and they might have an R&D company in Ireland. And then they can use this network of treaties. They can filter royalties from South Africa to the Netherlands through that treaty. They can filter royalties from Ireland to the Netherlands through that treaty. The companies can sit at the centre of this web of treaties, and no country which is part of the web will have a clear view of what's going on. If you look at that, you can see the spider